All right, well, welcome everyone. I'm just going to wait a few moments as I see the attendees coming in here before we begin. All right, well, hello everyone, and welcome to our panel today, Canada's Buy Now, Pay Later Moment, hosted by the Canadian Lenders Association. We have a wonderful group of panelists today and a really interesting discussion moderated by Gary Schwartz, the president of the Canadian Lenders Association. Gary's going to take us through a panel discussion, and after we will be accepting questions live. So please don't hesitate to submit questions throughout the discussion, and we'll try to get to as many as we can. And as always, this is being recorded and will be emailed out to all of you afterwards. So don't worry, you'll get a chance to watch it again. Without any further ado, I'll hand it over to you, Gary, to get the discussion started.
Great. Thank you, Danielle. I appreciate that. We have a great panel today. And why it's so great is I'm sure that you've been, on other BNPL panels, and it's usually a number of fintechs, sitting around singing from the same hymn book. What's great about today's panel is we have a really diverse pool of individuals from banks to fintechs to sector-specific individuals, and then right through to commercial. And so we'll get a chance to really talk about the sector from really different perspectives. So I want to introduce our amazing panel briefly, and then we'll get into discussing the sector. So I'm going to start with Amit, from RBC. Just a few lines on yourself be great. Oh, you're on mute.
Unbelievable. I can do that, 2 years into the pandemic. So hi everyone. My name is Amit Sadhu, and I lead RBC's unsecured lending business. I also have accountabilities for RBC's point of sale financing / buy now, pay later business, as well as our enterprise newcomer and cultural market strategy.
Fantastic. Fantastic. And Wayne from Affirm / PayBright.
Yes. Thanks, Gary, for having me. So I'm the head of Canada for Affirm. I've been in this role since the beginning of 2021, when the company that I was the CEO of, PayBright, was acquired by Affirm. So today we have about 250 people or so in Canada, about 2,300 across the whole company. We are in US, Canada, and Australia at the moment. And you may have seen us on one side of the border or another with merchants like Amazon, Apple, Walmart, etc. Yeah,
thanks so much, Wayne. Ilias from Vancouver, introduce Tabit to us and yourself in Tabit.
Yeah, great. So I'm Eli Bano. I'm the EVP here at Tabit by Merchant Growth. So we're essentially the same thing as Affirm and others like them, but for the B2B space. So we're focused on the wholesale side of the business.
Great. And then Eric, if you could introduce yourself, and you're on mute. There you go.
Thanks for that. Hi guys, my name is Eric. I am the COO of GoToLoans. I've been in consumer lending for close to 20 years now. Here at GoToLoans, we're essentially trying to bring the consumer, the buy now, pay later experience to the automotive service and upgrade side. So a little bit of a different offline industry, and that's a little bit about me.
Great, great. And what's so great is that all of these individuals are on a roundtable that the CLA hosts, which is, invite only BNPL lenders. And we have really representation globally. And if you want to just take a look at who's on that roundtable, I threw the link in the chat window. So I'm going to start with Wayne. So Wayne, we go back a bit. I kind of want to go down memory lane with you. And like any good panel, there's a beginning, a middle, and an end. And I wanted to start I guess a once upon a time question. So you started, when we started chatting, you were in a different sector. I think you were, health financing, and then you pivoted into BNPL. And when you did that, what was the impetus for doing that? And at that point, did you think the sector was going to be so explosive? Maybe just give us a little bit of storytelling around that.
Sure. Yeah. I mean, it's been kind of a wild ride. So I first got involved in point of sale lending kind of very end of 2015, early 2016 with Health Smart Financial Services, as you say, Gary, which was a very small pre-existing point of sale lender that was focused entirely on healthcare. And so I got involved in that business and, certainly liked aspects of the business model where you have distribution through merchant partners and a potentially low cost of customer acquisition as a result of that distribution. Like those are some of the beauties of the business model. There are others, but that's kind of the key to point of sale lending. And so all through 2016, we worked really hard to grow the health business, and we were making pretty good progress, but our observation was that that's a very fragmented sector. It's very hard to grow quickly, and it's hard to achieve kind of breakout growth. And so we said, well, we have a decent installment platform, and we know how to fund the business and how to underwrite. We've got some track record, but where else can we take these capabilities? And so we spent some time looking at different verticals. Should we go into auto? Should we go into home improvement? And we were looking for places where we'd have some sort of advantage, like any vertical where cost of capital is king. We were probably not going to be the winner, or any very competitive vertical was going to be difficult. So we were looking for like what's untapped and where does like technology and user experience really make the difference. And so then that's when the light bulb went off that e-commerce was this like untapped thing that we could do with a very simple installment product. And so we set about building that at the beginning of 2017, and we lay claim to Canada's first buy now, pay later transaction in the summer of 2017, which was through the Shopify platform of an ND mattress. So that was the beginning. And, instantly we realized we were on the right track, because when you get this into a checkout, a meaningful percentage of checkout choose the payment methods. You sort of have this instant adoption. The retailers see immediate results on a whole bunch of factors that we can go into. The customers respond strongly. And so we realized instantly we were onto something. And then over the next few years, we leaned into that and went to different retailers, expanded the product, went back in store with it. We could talk about all of that, but that's really the genesis. And we've just grown that business over the past 4 years or so.
So you saw like instant, product market fit, and then just honed that in.
Yeah, very much so. It was quite remarkable after all the blocking and tackling of in-store and health and trying to get adoption and usage and all this. But when you get this thing into e-commerce with a simple, easy to understand, customer-friendly product, it just goes, right? And all sides of the equation see the value of it. Right.
So today, I think we're gonna, explore that a little further. All those epiphanies. Who the customer is. Is that changing? Differentiation in the market, expansion of sectors, and things like that. So I wanted to start by exploring who the right now. Who is using BNPL? Who's the target consumer? Because I know that, a lot of people sort of, immediately, say, hey, it's a millennial. Is that the case? And maybe, anybody can jump in on that. And then we're going to talk about, is that evolving?
Yeah, I can go there and basically say that I think it's a quite a wide group. I don't think the product is just for millennials. I think consumers are looking for options. I hate to say this, if you go online, there are much fewer options to do a transaction. If you have a credit card, great. If not, you might be out of luck. Yes, there are some wallets, etc. Yes, there is Visa debit, but with Interact, there are a whole host of other issues. So yes, consumers are looking for options, and buy now, pay later, buy now is a credible option. And I agree, Wayne and team have done a pretty good job of being the pioneers in this space. So a lot of respect for, for his team for sure. So that's what we believe, it is for everybody. Yes, as we speak right now, as we look at the current set of transactions, the average consumer is younger. The average age is more in that millennial segment, but that doesn't mean that only millennials are using it. I would say that it is a younger demographic. It is definitely good risk people. We have not seen, comparatively speaking, any higher losses in this product versus others, and a reasonable amount of affluence based on, the categories where we do collect some income information. So that's again early observations based on the limited number of merchants we have, but that's what we are seeing so far in this market.
Right. So yeah, I mean, if you look at, sort of any sort of, a chart, you usually see, the younger folk, high on the chart, and then you get a little bit of a drop off around, around 35, 40. Is that maturing? And maybe just talk to your various sectors. Obviously you guys are representing, consumer, the bulk of your consumer. Obviously it's moving across to commercial as well, but just in the consumer sector, is the sector maturing? Are we tiptoeing out into sort of the boomer segment as well? What are you seeing?
I can speak briefly to what we see. So I agree with Amit that it is across all age groups. It does skew younger, but there's a huge factor, which is who are the merchants and what are their customers, right? So if it's a fashion e-commerce site and the average shopper is 22, well, we're going to see a lot of those people. But if it's furniture, things that you buy when you're building you just bought a condo, or electronics, we tend to see the whole range. So it really varies widely. I think the early digital adopters are younger people. They might have tried it first, but now we see kind of expansion along the age brackets.
Got it. And that brings me then to, the idea of, you're working with the merchant, and you're working with obviously the merchant's end customer as well. How are merchants seeing this? And are they saying, hey, if my customers are doing BNPL, maybe I should be doing BNPL as well? How is that conversation going, Wayne?
Yeah, I think it's reaching a point, certainly it reached a point in other countries now where it's kind of hard to not have this as a payment method. Like the buy now, pay later in, let's say, Australia, or even now in the US and increasingly in Canada, is going to become table stakes. There's these large networks of consumers. It's proven that having a BNPL payment method drives various benefits. And so it's, I think all of the merchants get that now. 3-4 years ago, as we were building this out, not all of the merchants got it right away, but that conversation's really changed. Like it's hard to name a single merchant who said no. Like they've either launched it, or they're thinking about it, or they're working on it.
Are they actually asking for BNPL services, for themselves as well? Have you seen, merchants coming to you and saying, hey, can I take a loan out in installments as well?
Yeah, and so yes, and one thing we saw is with the merchants. So we'll be serving their consumers, and then they'll say, all right, so you're helping me have a customer fund a purchase of one laptop. Well, I have a lot of customers that want 40 laptops for their business in one order, and we say, we're not set up for that. And so that's why it's so exciting to see, the Tabbits of the world moving in to capitalize on that.
Got it. So that's obviously a good segue across to Tabbit. Maybe if you could walk us through, as we continue to talk about the B2C play, what are you seeing in the B2B arena? You guys obviously, Tabbit, was created, through merchant growth. You service, merchants. Where did you come up with this concept, and what kind of need are you servicing in the marketplace?
Yeah, so unlike the B2C market, where this was relatively new, I mean, there were different types of installment payments before, but this sort of idea of BNPL in the e-commerce it was relatively new. In the B2B space, offering net terms, credit terms has been a way of doing business for a very long time. So there was already sort of a concept of buy now, pay later in the B2B space. When someone's making a purchase, you give them 30 days, 60 days, 9 days, whatever it is. So in the B2B space, I think the adoption is more so on getting merchants to understand that you're digitizing an existing process rather than a completely new process, right? Business buyers are already interested in getting these credit terms. They expect it. But the cool thing about B2B e-commerce BNPL like we're doing is that it's now also including the small businesses in this, whereby before there could have been companies that are offering net terms, but they're kind of saved more for the mid-market to enterprise clients where the risk is much lower, and small businesses usually have limited options. So the exciting thing is really including the small businesses and getting those same benefits. So I think to your question earlier, Gary, about who the buyers are, whereas in the consumer space, everyone may think it's millennials, but there's a wide variety. I think in the B2B space, people may think it's only going to be small businesses that are using this, but a mid-market company may also use it if it's 0%. I mean, why not? They're expecting credit terms. And so it also varies in our space.
Got it. And so we see this term, BNPL, buy now, pay later, is a very sexy, explosive category. But what you're saying is you're essentially just optimizing an existing process, maybe rebranding it a little bit by calling it BNPL, but essentially, you're taking an existing process and bringing it to market in a digital forward fashion.
Yeah, that and also a little bit different payback terms. Like, for Tabit, we will do installment paybacks, right? Installment, like a weekly installment up to 12 months. Whereas the norm in the net terms is usually 30, 60 days, right? So there's a different type of options and flexibility there that's added to it. But yes, the concept of giving someone, the ability to buy now and then pay it later in the business space was already there.
Got it. So what I find interesting about BNPL is, you think of it as a credit product, but a lot of the folk in the sector, think about it as a flexible payment tool. And so my question, and maybe Eric, you can take this one, is that, is it credit or is it payment? Or if you're thinking of it as credit is essentially you're just looking at the funding relationship. Whereas, being BNPL being at the intersection of, funding and spending, you're at this privileged position where you see both sides of the coin, and it's a very, different relationship that you have. Could you speak to me a bit about maybe, from the automotive sector, which I know you play in, how you seeing the relationship? And do people perceive of it as credit or payment?
Sure. So we've been around for a couple of years now, and we've learned a lot of things. Forget how we our name is Go-To Loans, and everything is so focused on a loan product. We realize that might not even be the optimal direction. We see there's a lot of constraints and hurdles when you are seen as a loan product. It's very different when a consumer sees you as an alternative payment method. So the way that you dress it up and you, I guess, present yourself to the borrower is quite important. When you think about a loan product, there's a lot of hesitancy. You think there's going to be a long process, there's going to be a credit application, and there's a lot of negative connotation with it. The ultimate goal is to move away from that, is to have a consumer look at you as an alternative payment method, that when they're ready to make a purchase for something, they're not thinking, should I get a loan for this purchase? They're just thinking, I'm going to use XYZ to pay for it. So the way that you set yourself up is obviously up to the corporation. But what we've realized and what we're trying to transition to, and there's going to be some fairly significant transitions we're going to be doing in the next couple of months, is to really try to move towards being known and the consumer feeling like they're going through a process, which is just a different way of making a payment. That's what we've seen is kind of the process that has the least amount of friction.
Got it. And to that end, what are consumers like? Obviously, there's a fair amount of adoption that we're seeing globally. Are these the individuals that are first adopters? Are they basically getting to checkout, seeing this option, and saying, "Hey, I think I'll try that"? Is there a lot of sort of test the water mentality with consumers and small businesses for that matter? But from an impulse perspective, maybe we'll focus on the consumer. What is that impetus for that first? I'm at checkout. I have these options, at my disposal. What's the impetus for choosing BNPL?
I can speak from at least our side. So we appear at a different time than just at the checkout. We're in an industry where unfortunately there's no e-commerce, nobody's repairing their car typically, and then paying for it over a website. So where we appear in a checkout is a little bit different, and obviously it changes the whole process. So a lot of times for a consumer, when we're talking about one of our borrowers, what's getting them to choose it a lot of times is obviously a ticket item. Our ticket price is into the thousands of dollars, our average loan. It's not the $20 or $30. But what we're also seeing is the credit, not that we pull credit, but we can see through other ways, is we have consumers with brand new cars, very strong credit. We can see the lien holders behind it, our prime lien holders, that a lot of the people are using us, not because it necessarily looks like they have a lack of credit, but they're getting a convenient payment option. And when they came into that mechanic to pay for the $2,000 set of tires, they already intended to pay for it. They already knew that they were going to pay for it. So the decision that they're making at this point when they're being faced with the bill is really two things: is the financial program that you're offering competitive to my credit cards or close enough? And is it easy enough to use? And if we believe we can build upon those two things, what's going to get them to do it is a lot of different reasons for them personally. I don't think a lot of them are doing it for the excitement of let me try something new. It's probably because there's a tool that they feel is beneficial for them, is useful for them, helps them with their planning, and that's kind of what I would see that as.
Right. So, but if with Wayne and maybe if you're not in a privileged position of swimming upstream and engaging the customer, but you're literally sitting there at checkout. Is it in this impulse decision? Is there are people brand agnostic? Are they seeing your brand at checkout as the option or just a option? And how do you differentiate yourself, given that there are lots of options that the consumer has at checkout now? And how do you differentiate your brand and your offering?
Sure, Ahmed, I don't mind. I can go first. I think initially in the early stages of development, the customer just discovers it in checkout. They haven't necessarily heard of it. And typically what entices them to use it the first time is it's a great offer, right? So let's suppose you're going to buy an iPhone online and it's 24 months interest free. The way our product works, that's truly interest free. There's no deferred interest. There's no retroactive interest. There's no compounding revolving interest like a credit card. There's no late fees. And so it's almost like, well, why wouldn't I give that a shot? And then we find that customers try it. They realize that, we meant what we said, that it's really easy to use, that it doesn't have any nasty surprises the way that so many retail credit products have had for so many years. And then we see the repeat usage, and the repeat usage sort of goes up over time. But differentiators, having the very fair and friendly, transparent terms is critical, and then the ubiquity and the size of the network is really critical. And then the more you can have these interest-free merchant-sponsored programs, the better. And then what we're all in the phase of doing now is what are the other services and benefits that we're bringing the customer beyond just the installment payments? I mean, my view is where the industry is going is just that installment payment thing is just the first step. Like there's more services and value add that we can bring the consumer post-purchase. And so that becomes part of the differentiation as well.
Yeah, and this is a good segue to you, Ahmed, is that, if the consumer is getting more and more sophisticated and they not just, hey, I'll try this out, like you got 30% increase in BNPL, traction last year. Is probably going to be significantly higher this year. With a sophisticated consumer and laddered services and laddered options, is the consumer becoming feature driven? In other words, they say, hey, this is the baseline, I have these, flexible payment options. And, are there other things that I can now gravitate to from a loyalty perspective? What are you seeing out there as a bank? I mean, that's your bread and butter, right? Is loyalty and engagement.
Yeah, I think that's a great question. Like that's, as Wayne mentioned, early days, and right now we are looking at some table stakes elements. Like now, are we delivering on that promise to the consumers that that will give you plain terms. There'll be no hidden fees, charges, or gotcha elements in our terms and conditions. So that's where we are, and hopefully we'll continue to maintain those good sound practices in order to continue the piece around the trust of the consumers. And similarly on the merchant side, to the extent we continue to elevate the merchant's brand as much as our own brand, to make sure that we are ultimately not disrupting the shopping experience. We're not trying to take away the merchants' consumers to us. That's also critical for us to make sure that we continue to have the merchants trust as well. But over time, yes, as Wayne mentioned, we'll continue to evolve. The intent would be, if you look at the history of credit cards, it all started as a very simple transaction medium, and today there are rewards, insurances, and what have you. And we do fully anticipate that over time, some of these aspects will be introduced to the BNPL category as well, or at least there will be some players who would integrate some of these other features to these products too. But we are in our infancy. It's like credit cards in the 1960s, before rewards and other loyalty aspects were more prevalent. Right now, this is about, yes, as Wayne mentioned, earning the trust of our consumer clients and our merchant clients, and over time there'll be more bells and whistles, which will make it more of a loyalty play.
Got it. So there's some great questions going on, and I just want to thread them in. I'm going to get back to this whole idea of bank versus fintech in a second, Amit. So I'll be back to you. But just one question for you, Wayne. When we're talking about laddered services and expanding, that was just the start. What other services are you layering in, as a question from the audience?
Sure. So, I think things that are sort of public is, in the US market, we rolled out this super app that has a savings account within it. We're trialing crypto accounts as well, which sort of became in demand. We have a marketplace where customers can go and kind of shop in a virtual shopping mall, if you will. We've also are in the sort of rolling out something that we call Debit Plus, which is our first physical card, where a customer can get a physical card, go and either make a debit purchase or choose to make that a BNPL purchase kind of at the point of sale. So we're kind of expanding that suite of services, and we have the same approach on the merchant side as well. So for example, we acquired a company last year called Returnly, which is returns facilitation for our merchants. So we've got this two-sided network, right? Consumers and merchants. We've got the basic product, which is the installment payment product, and how do we keep adding value to the ecosystem?
Got it. And that's an interesting one, because obviously as a fintech, you're more nimble and can, through M&A or through internal development, come up with those solutionings, based on iterative process with the customer. So that's very exciting. I want to go back to Tabit for a bit. So you just launched this product, obviously, again, on the commercial side. What are you seeing? Are you seeing similar, from the insights of the panelists, are you seeing similar things in your future? Using this as a base, then add-on services, using this as, if you think of it as a ladder metaphor, the first rung in engagement around, the needs of the merchant.
Yeah, I think it's going to be the same thing in our space. I mean, you got to remember that the business buyers are consumer buyers outside of business hours, right? They're they're the same kind of habits, and they're starting to expect it more and more in the B2B space. So to answer your question, I think for sure what we're doing now is sort of the baseline, and then we're going to be able to add a lot more. And one of the examples would be, what kind of analytics and data can we provide to the merchants, for example, who are using Tabit based on their users' behaviors or something like that. So, there's extensions on both sides, both for the buyers and on the seller side.
Got it. I wanted to get back, to Amit, this whole idea of, there's fast growth in the sector. People are trying this out. They're seeing value. Companies like Affirm are layering in additional, value. From a bank's perspective, do you see the fact that trust is always, part of your mantra, right? You're a trusted partner. You're on every corner, every corner. A bank is sitting. They're part of our community. They're a brand. And so, do you see, once the hype of trying different services maybe subsides a little, that the bank and its brand can come in and provide sort of consolidated services where it's BNPL and other services can be consolidated into one dashboard? Where do you see things moving from a bank perspective?
Yeah, no, that's a great question, Gary. And I'm often asked this question about, banks versus fintechs, to which, I start by explaining that, look, banks are fintechs too. We spend billions of dollars on technology every year. And then we are, of course, very, very open to working with other players, including what is generally understood to be fintechs as well. So for us, as you said, it is all about meeting the needs of our clients, the merchant clients and the consumer clients. And yes, as you said, the trust is a pretty big part of it. We do have some great relationships with a lot of merchants and consumers. We have almost relationships with 1 million small businesses across the country. Around 13 million Canadians are clients in one shape, way, form, for sure. So yes, that trust is something very important for us, and part of that trust is making sure that we are meeting the needs of our clients, and not trying to look for profitability at every for every product and every service incrementally. So that's for us is our key value prop to our clients, that yes, we will meet your needs. We will meet those needs in such a way that we have your best interest in mind, and our clients trust us that when we come to them with a certain service, both on the business side and on the consumer side, that is an important selling point for us, that this is in your in your best interest. And yes, beyond trust, as you said, consolidation is the other piece. As opposed to Americans, a lot of Canadians don't want a lot of fragmentation in terms of their financial services providers. And to those Canadians, we are a very good option. That look, we have you covered in all the other products that you have, including the buy now, pay later products too. And then finally, yeah, rewards is a pretty important part of our business. It's a well-known fact that the RBC Rewards Program is one of the largest rewards program in the country, and that is part of our offering right now. It's not integrated with our buy now, pay later offering, but as we scale up our buy now, pay later product, our pay plan product, we do hope to integrate that with our rewards value prop as well. And that's that's what we are hoping to do ultimately for our clients, meet their trust, help them consolidate their different services, and then finally reward them for going with the the portfolio of products and services that we provide, and that's our value prop.
Got it. There's some questions. I'm going to get to them, I promise. But I wanted just on that note to talk about cannibalization. So you've got incumbents like yourself and that have certain mature offerings. This is a new offering that some people think will cannibalize the credit card marketplace, but will it really? Is it something which is, as we've indicated, something very different from the traditional revolver credit relationship? Eric or Wayne, you can chip in here if you want, but do you see this as being something that the banks are going to fight tooth and nail, or is something that organically can live within the same ecosystem as an evolution of services?
I guess I'll jump in.
Sure.
So there's no question that there's a few places we're trying to convert our borrowers from of where they currently source their funds from, whether it's a credit card or debit card.
You're cutting out a little bit, Eric.
A private lender or something like that. People from using other sources. For 1 second, I'm going to speak to someone.
Okay. Wayne, did you want to just take that on, the idea of cannibalization? And
yeah, I mean, so there's just, there's a certain amount of incrementality that buy now, pay later brings by, customers who, don't want to use their credit cards or don't have credit cards. So we're providing an alternative payment method to them. There is some cannibalization of credit cards. And, Amit has to cover his ears here, but we, we think that's part of our job. Like, there are credit cards. I'll just do my little credit card diatribe for 30 seconds and I'll get off my soapbox. Credit cards are the most amazing, easy to use things that are accepted everywhere, right? But they're also a financial instrument that has a lot of drawbacks, right? You have a grace period, but then if you don't pay it off, you have, compounding revolving interest at 20+% and late fees. And something like 40% of Canadians carry a balance every month and get stuck in this, right? And so to the extent that our product helps those customers get on a, clear, understandable budgeted payment, not pay any fees or deferred interest and stay out of that credit card trap, we think that's great. So to the extent our cannibalization is making those consumers' lives better, we're delighted.
Got it. Yeah, sorry, Eric. You can jump in, but I wanted to pivot a little bit because there's some questions on delinquencies, and I know there's a whole chatter around the detractors to the industry. I'll talk about Canadian indebtedness, that that this is just another nail in that the consumers. I don't know if the metaphor coffin is a good one, but there's another burden that the consumer needs to carry. And so what kind of delinquency do you see in the sector, and how do you mitigate any concerns? Are you doing affordability checks? Are you making sure and that you're measuring financial resilience in the market? Maybe just talk a little bit about the sustainability of the marketplace and touch on some of the delinquencies and concerns that you may or may not be seeing. Anybody can jump on that one. Eric, did you want to go?
Sure. Sorry, what can you what was
so my question is, are you seeing delinquencies? Folk are looking at BNPL and saying, there's a lot of indebtedness in Canada. We're moving into an inflationary period. Are the affordability checks that you're putting in place? What's the sustainability of the marketplace?
Fair enough. So understanding risk of any loan is different for every company. Companies view risk differently. They adjudicate risk differently. In my past, we used affordability. We used credit bureaus. We use a lot of different things. In this specific industry we're in right now, we determine, our theory is that we can determine risk based on the car you drive. So it's a little bit different. What we've seen is if you have a more expensive car, if you have a newer car, we've been able to correlate that to a lower delinquency rate. So understanding risk and affordability can come in so many different ways, as long as you have the track record to be able to prove your theory and your thesis. So we do go through a process like that, trying to understand which car they drive, and through that determine what their risk is. And then when it comes to delinquency, we have a very different product than everyone else. Our loan products are secured to an asset. So people do treat them differently than an unsecured loan. Just the recovery is a little bit different. It's quite different. So obviously our, ultimate bad debts, the amount of capital that we put out that we don't collect back is relatively low, since there's an asset behind most of it. So I wouldn't say generally, you can say just payment plans, what's the delinquency rate? Every industry will be a little bit different how the loans are structured, or, going to make a big effect. But specifically for us, it's relatively low because we've been able to secure them to an asset.
Got it. So let's I want to ask, on the Tabit side, and I also want to ask the firm side on the unsecured lending side, the same sort of question. But let's just go to Tabit. Did you see BNPL, in any way sort of, being challenging for merchants? Is it something that it makes it easier or more burdensome for them in repaying their debt? What do you see for either mom and pop, Main Street Canada, or sort of larger enterprises?
So the BNPL product itself, like you mentioned earlier, we just launched it this year. So, maybe I'll give it a little bit of time before really being able to answer that concretely. But Merchant Growth as a whole has been offering this kind of financing for, over a decade. And we've kind of gone through these ups and downs of the economic sort of downturns and so on. And there's different ways of mitigating it. But I foresee the BNPL product being a little bit less risky than normal traditional loans, because there's one purpose of it, and it's usually for inventory, for growth. The money's being funneled directly to the merchant, as opposed to a traditional loan, which can be used on several other things. So I think BNPL is a bit more of a risk mitigant and less risky than a traditional small business loan. But yeah, I think on the BNPL side, probably Wayne's better to answer this one.
Yeah. So on the unsecured side, which is, I guess, the big focus here, how do you answer that, Wayne, when somebody knocks on your door and says, hey, this is another burden for Canadians to bear?
Sure. So I think it's really important for everybody to understand the different business models, right? So for many years, certainly in Canada and in other countries, the business models that have been used in retail credit have involved making money, having a revenue generation from people not clearing balances, falling behind on payments, right? So revolving compounding interest on credit cards, deferred interest on store credit cards, late fees. All of those are ways that people have made money from customers' misfortunes and mistakes. Certainly our product and others of our BNPL, brethren, if you will, our products are not designed that way. So it is in no way in our interest to have a customer fall behind, because we make zero revenue. We don't have any of these revenue tools, right? No late fees, no deferred interest, no nothing. So we do not want customers to get in trouble and fall behind. So we spend a whole lot of effort and money and brain power on underwriting every single transaction and making sure customers stay on track, because if customers do become overburdened, it is a direct loss to us. So everybody needs to remember that. So all that said, our delinquencies are sort of quite low, low single digits. I don't want to preempt our earnings release, which is happening in a few minutes, but if people want to look up our latest disclosure, it'll be online shortly.
Got it. So and maybe just explain to the folk in the crowd a little bit about how then you do make money. So if you're not making money on you don't want to make money on late fees, and you don't want to make money on tapping into interest, because you can't, that's not your model, then you're making money by establishing a trust relationship with the merchant, correct? And they're essentially paying down that risk for you, correct?
Correct. Yeah. So the large majority of our revenue, and certainly in Canada, is from merchant fees, where a merchant has said, this is a benefit I want to offer the customer. It is attractive to my customer to be able to pay over time interest-free. So I'm going to pay the Affirms of the world a fee for that. And so that's the majority of our revenue. We have one other type of product, which is a simple interest-bearing product, where the customer pays a straight non-compounding interest rate over the term of the loan, and then it's done. And there's no surprises or fine print. So in Canada, the vast majority is interest-free. And then there are some types of merchants who have fairly thin margins in their business, and then we use the interest-bearing model. Those are the two things that we do.
Got it. And that's
Can
why
I just
go ahead, please.
add a little bit to that, just as a segue? I think in the B2B space, sort of the back half of what Wayne was saying, with companies running a bit tighter margins, we may also, we'll be offering a 0% option, but that may be a shorter period. That may only be for 30 days, for example, where the merchant says, hey, I'm willing to subsidize, and incur the risk here for the first 30 days. But then you can extend up to 12 months to the buyer on a simple interest rate, just like they would do. And so there may be more of a hybrid model going on in the B2B space.
Got it.
One more point about the whole credit piece overall, if you think about the these 5 C's of credit, credit, collateral, capacity, character, etc. If you look at the character piece, 100 years ago, the way character was established was somebody who needed a loan would get at least 2 letters of introduction from somebody that the bank knew of. If today the banks ask for letters of introduction from clients before giving loans, I don't think any client would ever do that. That simply is unheard of in this day and age. And what has replaced that, it's not like the banks no longer look at character before extending credit, but credit bureaus become a proxy of understanding a client's credit history, becomes a proxy of knowing whether a person has good character or not. So it's the same evolution here, how we evaluate all the other elements like affordability, etc. That's being done more algorithmically now, with more math and more information behind it. As Eric mentioned, the type of car is this type of piece of information that plays into that. Now, I agree there are certain areas that we as an industry need to get better at. So yeah, reporting to credit bureaus is a good example that somebody mentioned in the chat. Those are areas that we should look for. If there are 20 buy now pay later firms and everybody is extending credit without knowing that full picture of a consumer, yeah, that's not good, and can definitely even with the best intentions can land a consumer into trouble. But those are elements that we will all come together and work for. Right now the industry is in its infancy. We can't create a lot of requirements right now, but yeah, over time some of these things will get added, and we're reasonably confident that that those elements would also get taken care of over time. So just my 2 cents on the on this credit question for sure.
Yeah, and that's actually a really good segue into the whole idea of credit building, which I know as we mature the sector, everybody's saying, okay, well, now you're now an established piece of the ecosystem. Why does a consumer go in there or a small business go in there? They take down a loan, they pay it off, and they're not rewarded. There's no visibility into that repayment. Where do you see things going, for BNPL? I know that in the UK, it's just been, the regulators have pushed reporting to the bureaus. Do you see similar things happening in the Canadian market?
I think speaking for us briefly, I think we will all end up reporting, and I think in Canada there's a good chance it's sort of voluntary. That's the way we've gone in the US, and it probably makes sense in Canada. And to be completely transparent, the reason we haven't done it in the past is it's one more thing to build, and no one was requiring us to do it. But as we mature and gain scale, it makes a lot more sense. Okay, so it's you see it as sort of just a maturation of the marketplace, and inevitable. There are 2 resources while we talk that I just wanted to put in the chat.
One is a myth debunking tool that we have that I just put into the chat, which basically takes a lot of the chatter that you see in media and sort of disabuses it a bit, goes through it and explains, why some of those, the assumptions that are out there are incorrect. Another resource I wanted to put out there is a white paper that we just put together on a B2B BNPL, which is a fascinating read. Kindly sponsored by Tabit as well. So two great resources for you to, take note of. I'm going to, I don't think the conversation would be a good conversation if we didn't talk about, a post-COVID, moving into an inflationary period. How do you see, the things, trending? COVID obviously accelerated adoption online. That is the underpinning of a lot of, where BNPL lives. And so that was, obviously a growth period. Will inflation drive or stifle growth? I look to Brazil, which is the cradle of BNPL, and really high adoption of BNPL in an inflationary marketplace. Where do you see things going over the next, a year or so with inflation rising?
I guess I can jump in. Anytime there's an uncertainty, people might be looking for an alternative from what they have, whether it's leaving their credit cards open for other purchases. Inflationary times don't necessarily mean a bad thing for everybody. Of course, us as lenders, we have to review our cost of funds. As we borrow money from senior lenders, that becomes variable. So there's that whole point that obviously we have to watch, make sure that we're flowing any potential extra costs that we can't afford back onto the loan if we need to, not that we were planning on it. But in inflationary time, just an idea of uncertainty is what people have. And this is where people might turn to structure. I know for us, COVID wasn't necessarily great. People working from home, they weren't driving their cars. They would maybe repair one car out of two cars. So it was a little bit different because of the product. But there's no question that the need for alternatives is growing in times like these.
Anybody else on the inflation question?
Yeah, I think we generally think that to the extent, people's budgets are squeezed and they're looking for predictability, it's a very helpful product. So I don't think we have huge expectations around what inflation does for us, but we certainly think we have a useful product in an inflationary environment.
Right. Anybody else before I move on from inflation?
I would echo Wayne. I think he's absolutely right. At the end of the day, we expect we have a product category here which has a strong rationale for existence. Yes, what inflation and rising rates associated with it might do is bring some more pricing discipline into the market, but other than that, we do anticipate the product category to grow. In fact, to the extent it will actually be on a more sustainable growth path versus an artificially propped up growth path, if that's driven by just incentives and those kind of short-term gimmicks.
Got it. A lot of questions, and I'm sorry I'm not getting to all of them, but a lot of questions are on, what's the growth of the market, where are things trending? I kind of just wanted to jump into that crystal ball for a second. In the world of BNPL, I don't know how far you can look out, because probably a long term is 1 quarter. But if I could just ask you guys to see where your industries are trending. So from a commercial perspective, from a sector perspective, like, automotive repair with Go to Loan, from banking, like where are you going? Where do you see this evolving? And you can go 2 years out if you want. Hey, hell, you can go 5 years out if you want, but give us some fun, talk about, splitting payments in the metaverse. Like, give us some sense of where you think things are going. I'll start with,
I'll
well, I'll start, it's anybody can jump in.
Yeah, I'll start from a quick from the B2B side. I think the future for us is we're already sort of 5 to 10 years behind the consumer space when it comes to B2B e-commerce. And so there's a lot of sort of catching up to do on the B2B side, but I think it's going to become table stakes and normal as the small business buyer, or even just the B2B buyer, the millennials and others have more and more influence over it. So this is going to become more and more expected. So I think that the adoption of BNPL is going to continue to grow over the next 5-10 years. And then after that, will crypto be added in the business space? I don't know. That's maybe a bit of a stretch in the 5 years, but there's a lot of different features that can come in to make B2B buying similar to the B2C space. So before we get to those kind of crypto and all that, we just want to catch up to B2C and make it just as seamless there. I think in the 5 years that's a realistic expectation.
Got it. Anybody else looking into the crystal ball? Yeah, but Wayne, go ahead.
Sure. I mean, yeah, I think based on, having watched this develop for 5 or 6 years now, and based on what we're seeing today, like, it's pretty clear to me that this will become an increasingly mainstream payment method. We're going to see most merchants offer this among other payment methods. And we're going to see a large percentage of the population have these accounts. It's going to take a few years, but if you look at, let's say, Australia, there's huge penetration. I think they're probably 3-4 years ahead of us, consumer and merchant penetration. And the number, for the first time in their history, the number of credit cards is in decline as people are using BNPL accounts instead. So I don't see why we can't follow the same path. And then my other prediction is, like I mentioned earlier, the ancillary services that are going to be built around the installment product. I think that we'll see a lot more of that.
I have to go to Amit after this one. So, what's in the crystal ball? Do we see declines in certain service sectors and a shift towards BNPL and others? Like, what's in your crystal ball for the bank?
Yeah, we don't see it as credit card versus Klarna kind of a thing. We'll probably have, as Wayne mentioned, multiple payment options. The key piece, we do believe is, buy now pay later will become more mainstream. If you think about it right now, it's a bit something which is more focused on the product side of the equation. The travel may be the only service which is included. Imagine a world in which a person offering spa services offers buy now pay later, come and get a massage and pay it off over 3 or 4 payments over the next 6 weeks. Those are the areas where the next phase of growth should definitely come from. And then of course we'll continue to have more payment options. 10 years ago nobody would have envisioned buy now pay later in its current shape to evolve. There probably would be more interesting payment options that would continue to evolve. But yeah, absolutely, that situation where you go online and the only way to pay is through a credit card, I don't think that was ever sustainable. And we're all glad that that we are getting to that situation where these payment systems are beginning to converge. We have not talked about the Visa installments and what have you. So clearly, the credit card on the credit card side, the product is becoming more and more like buy now pay later. So there are those buy now pay later kind of features that are being added to credit cards. So there is going to be, like as Wayne mentioned, credit card is a very, very flexible payment form. It has some areas where there are some gaps, but over time those gaps would also, I'm pretty sure, will also get filled, and we will have a world in which there will be multiple payment options, which will start looking somewhat similar to each other over time, but will still provide merchants and consumers some customization options.
Got it. Eric, $21 billion sector that you're going after. It's pretty huge, right? In automotive repair. What's the future of that for you?
You know what, as everybody else was saying, what we're seeing essentially is a shift in consumer buying behavior and buying habits. I can bring an example. 15, 20 years ago, you would see a car being advertised with the selling price of the car. Now the way it works is if you ask someone what's your budget for a car, they're no longer saying it's $20,000 or $30,000. They're saying it's $300 or $400 a month. The way consumers are starting to perceive costs is changing. The way that they're starting to perceive the way they pay for it is changing. And there's a lot of factors for that. I mean, you can see the proportional wealth of millennials is not the same as it was for older generations. Minimum wage is tough. Housing is tough. The entire financial ecosystem is different for a younger person. It's not necessarily just that they like using technology. There's a lot of factors that are forcing them to budget in a different way. So without all of these outside factors changing, which I don't think they will, I think people's buying habits are going to continue changing, and they're going to continue looking for methods that allow them to enjoy their life a little bit based on the budget they have. That's what people are trying to do. They're trying to live their life, trying to be able to get a house that they like, or a car that they like, or products that they like. Nobody wants to, not afford anything. So the way that everything's changing, I just see it just becoming much more prominent.
Thank you, Eric. And that's actually an amazing end to a fantastic panel. So I want to thank everybody. I have cut and paste all the questions, and what I'll do is, if we can, maybe we'll put up a resource that answers all of them post-panel. But thank you, everybody on the panel. Thank you, everybody in the audience. And I'm going to throw things back to Danielle.
Yeah, no, I know we're at the end of the hour, so I just want to quickly thank you all, of course, our panelists, for your incredible insight, and to you, Gary, for moderating the really great discussion. And thank you for everyone who joined. It seems like there's a lot of really great feedback in the chat, and for submitting all these great questions. I also, of course, want to give a huge thank you to our sponsor, Tabit, for bringing this panel together. And just in closing, we encourage all of you to join us as members of the CLA community and participate in the fintech lending community. And of course, to continue attending upcoming events, you can find them all at lendersevents.com. But with that, I'll close things up, and we will be emailing you out a recording of this session. Thank you all, and have a great rest of your day.